Yeah, I mean, it's definitely a high probability event. It's not our base case. Our base case remains 125 this summer, but the upside of risk around it, puts a high probability around 150. So why are the risks so high?
Oh, but Jeff,
First,
come back. When you say high probability, just before we even get into why, what the probable is, when you're doing the math, how do you handicap that?
We just, it has a really long tail, 175, 200. We don't know how high it can go, and there's several reasons for that. Our models say demand destruction kicks in around 125. However, when we look at the way those models are constructed in the history, the environment today is much different. Why? Because you have subsidies going to lower income groups, particularly in Europe, which is be the center of demand destruction. But you also have subsidies, going to many of the emerging markets. India, Indonesia have stepped up to the plate. The other factor, savings are still quite high and credit capacity is high. That means it's a very different environment in terms of affordability for the consumers around the world. So while the historical elasticities of demand in the models would suggest 125, the upside risk around that, I think, are substantial.